Hey guys, Doug the Retirement Guy. We're going to do a review here of the Yieldmax Netflix ETF NFLY. Is it good for a retirement fund or is it good for more income? They advertise a 69.18% dividend yield. So let's take a look at this one. The Yieldmax NFLX is an options income strategy using Netflix as the primary focus around. Now, as you see a lot of this with Yieldmax on a regular basis, they pick one stock, this one's Netflix, and they buy into it, and then they turn around and basically do covered calls, short calls onto Netflix and generate income from it. Plus, they take a lot of money and they pour it into treasury bonds and securities to generate additional interest and income from that. So their distribution rate, they say, is 74.82%, 30-day SEC yield 2.85. That's a little low for options trading programs, but let's take a deeper look into it. In their holdings, very clear, exactly what we expected to see, and that was the Treasury bills and notes and bonds, and then Netflix across the board. So why NFL? Why? Well, first off, it's always the 74% return that people are looking at because they want big returns quickly. But when you look at something with a 74% return, you got to remember it's over a specific period, and it's also over both in the income from the dividends, any interest, and any capital gains that they have. So those numbers are normally they're increased because of all that. But when you see a number this large, it always suggests a high risk, a lot of volatility, and that comes from options trading. There's no way around it. You're going to have ups and downs in options trading, and that's where the volatility and the risk comes in at. The 2.85, it's a good number. It's not a great number. We normally see these things in the 3s and 4s on option traded items. Anytime you see something above the 1, you know you're going to get good potential payout coming from you in the dividend category. But the higher that number, the more payout you're actually going to get. Now, they do offer monthly dividend payouts, which on the channel we love weekly and monthlies, definitely. That's where we really focus hard on. And the reason for that is when you have a monthly dividend, if you want to reinvest this dividend, now this is not what most retirees will do, but this is what investors will do. They'll take and reinvest the dividend, buy more shares each and every month. And when you do that, you're compounding the effects of your return. What we like here on the channel and focus on is that regular cash flow. I want that regular cash flow so I can pay my monthly bills and I can make continuously cash coming in, cash going out, and living day in, day out without really much worry. So if we take a look at what this return is, if you look at 1 month, the market's 8.16. The NAV, which is the value of the stock, is up 7.68. 30 days, right in there, 20%. That 6 month to 1 year, the 6 month is 44%. Good numbers, solid growth over past 6 months, half a year. The year to date, remember, that is strictly because we're only into January. And this number here will pretty much only produce what 1 month is, and that's the month of January. 1 year, they're at 62%. So you can see in the last 6 months, they had some very strong growth in value. And it looks like the first half it was slow starting. But then since inception, very, very solid numbers. So what we always do is we take the account and put $10,000 into the investment side of it, and we can really look at what happens here. On March 13th of 2024, stock price was $13.39, $10,000 invested would have gained you 543 shares. You look at the dividend, what they pay out, and this is what I like about this one fund is you're looking at the lowest is 38 cents. The high is $1.07. But across the board, that dividend bounces in between that 70 to 80 cent price range. So it gives you a solid, very strong cash flow each and every month. But we always start out looking at the value. If I start off with $10,000 at the end of 12 months, what do I got? And here you'd have $168.56 extra. So you got 1.69% growth in the value of your stock. You have a dividend payout of $4,719 or 47% return from that $10,000 investment. And if you combine those two together, you have a total return of 48.88%. So these are some very strong numbers, and you can see it's heavily focused on the dividend return versus the stock return. And it goes which way you want. If you want big dividends, go for it. If you want stock, return on your dollar investment, you can do it. If you take the dividends, put it back into it. But this one doesn't have as good of growth as you want, but great dividends. Now, the other thing we do is let's take this and look at the chart over time. And you'll see NFLY is flat. And that's actually a good thing. That's why you don't see the real big growth on the value of the stock, but it's paying that big dividend. The average price is $17.62. That's where this line floats right at the bottom. And now you see at the end, it took a nice curve up and then it took a drop down and it's going back up. So we're pretty much seeing that NFLY is almost floating exactly to what Netflix is doing. Is that if it holds its own, it's doing great. Netflix climbs, this is going to climb. Netflix drops, this is going to drop. But across the board, they're able to keep that average price in mind. So again, the part shows that it holds the low price value for long periods of time. It is in Morningstar, risk is rated at a 2, which is a very low conservative investment. So as they say, you're not gonna get rich from it. You're not gonna get poor from it. You're gonna roll right down the middle of that line. And this line shows you here as well that you're right. It's a low risk item. So in summary, the stock return over the past 12 months is 1.69, and that gets a thumbs up. Dividend, 47.19%. And that is 3.93% a month, or $393.25 a month on a $10,000 investment. So like I said, you invest $100,000, you're going to expect about $3,900 a month. So it really comes into is how much money do you need, and this can give you a calculation of where you should be. So we give that one a big thumbs up as well. And your total stock return, 48.8%, including the dividends. And I think everyone knows at this point, dividends makes up 99% of that number. So it gets a thumbs up. So this stock here is really for someone to really dial into. They want dividends to do things with, and it pays off very well. So is NFLY good for a retirement account? And the answer is definitely yes. It's definitely a strong one to have in your account. You got the Morningstar low risk, which we love. You got the dividend at 47.19%, which is great. That's awesome to have that in there. And you don't have really much NAV erosion. 1.69, it's actually increasing. So your NAV erosion is very strong. Even if we took this thing out 18 months out, you'll find that the NAV erosion is very, very minimal. So it's a safe bet to have the money into, which gives you nice total gains of 48%. But realistically, you're focused in on that dividend account, especially for retirement accounts across the board. So we put this one definitely as a moderate buy. If the value of if the value increased, it was more than 1.69, we'd be into a strong buy. But at 1.69, we keep it a moderate buy. It's safe and fairly good to go for them. So hey guys, this is Doug, the Retirement Guy. I hope you like the information we're giving you. If you do, press that like button. Give us that thumbs up. It helps the channel. We're just trying to help keep the channel growing and moving forward. Don't miss any of our great videos. Hit the subscribe button. We're constantly putting videos out, helping you learn about the stocks and what's good for retirement. If anything, don't be afraid. Put a comment down there. We're willing to accept anything, good, bad, and the ugly. We're willing to talk to you, listen to you, give us some advice, go from there. Everything that you do helps the channel grow. Appreciate it, and we'll see you next time.